Everybody talks about conservative underwriting.
Yes.
So what does conservative underwriting mean for you?
That's a really good point because a lot of people do talk about it. What I do is I look at historical data and underwrite for those numbers. Where I was looking at deals and saying, no, historically, this is a 6 cap market. I'm going to underwrite for a 6. I think some guru came up with that plan, and I have nothing against gurus, but
how do you calculate the exit cap? Because that always seems to be a pretty important metric.
Trying to find assets that I underwrote in a very conservative manner that provided good cash flow and, when possible, fixed rate debt. People who were running the deal were very clearly didn't know what they were doing, didn't have their eye on the ball, and the communication was terrible. We did buy rate caps, so that's great, but rate caps also expire after a certain period of time.
That's right.
There's a great Mark Twain quote that I love, which says, history doesn't repeat itself, but it often rhymes.
Welcome to Real Estate Syndicator Live. I am your host, Mauricio Rauld, and on this episode, I've got my good buddy, Matt Picheny of Picheny LLC, a syndicator with a ton of experience, over 15 years to be exact, has about 4,500 units, $638 million, and maybe more impressively, he is a 2-time Tony Award-winning producer, and most recently just got the American Apartment Owners Association Award for the best multifamily investment coach. In this episode, we talk a lot about underwriting. He actually does a deep dive on underwriting. We talk about cash call, rate caps, cap rates, and where he sees multifamily going in the near future. This week on Real Estate Syndicator Live. Matt Picheny.
Yeah, that's right.
We're here at the Multifamily Investment Network here in New York.
You're
emceeing.
I am. This is my hometown, Brooklyn.
Yeah.
Are we rolling yet, or
I don't know. Who cares?
Right.
We're just going to go with it.
All
So
right.
you're emceeing the event. You're doing an amazing
I'm
job, by
emceeing
the way.
event. Thank you.
You're crushing
Thank
it.
you.
Have you thought about being an actor or something?
You know.
So for those of you who don't know, you are not only a prolific multifamily investor, a prolific syndicator.
Yeah.
You're also a 2-time Tony-winning producer.
Yes.
Thanks to syndications.
Thanks to syndications, and thanks mainly to my amazing wife.
Well, we all know that your wife has all the talent. I mean, that goes without saying, right?
She has all the talent, but, well, I don't know. I might be more talented than her, but she definitely has the business sense. You know, she works on the business end of Broadway, and she has a lot of opportunities because of that, because of the fact that she's so ingrained in it. And a lot of the shows before they go to Broadway will go to theaters that she works on or manages or oversees. That she gets to, have her finger in the pie a little bit, so to speak, and contribute to the development of the show. And that's allowed us a couple of times. She's done a bunch on her own. She has 3 Tony Awards.
Oh, wow.
I only have 2.
I would expect that, yeah.
But the 2 that I have I co-produced with her.
Right.
Yeah.
That's awesome. And so most people think, just because that's our world, right, that you can only syndicate real estate or, it's whether it's multifamily, self-storage, whatever, but you can pretty much syndicate anything. And in your case, because of your background and your wife's background in theater, you were doing a lot of capital raising to fund some of these productions, right?
Yeah, that's right. Yeah. That's right. It's been really rewarding because, as you mentioned, I used to be an actor, and I still have a passion for the arts in general, and specifically theater and music. So to be able to still have my hand in that a little bit, so to speak, even though my full-time job is real estate, it's rewarding to me and something that's meaningful.
So as a full-time real estate investor, I think multifamily is like your bread and butter. I know you do other stuff as well, but so obviously multifamily has been in the news a lot lately, the last probably 12 months, 18 months. From your vantage point, give us kind of a lay of the land of where we are in the multifamily space in terms of, obviously prices have come down. Where are we in the proverbial nine-inning baseball game? What inning do you think we're in? And give us a lay of the land of where we're at.
I wouldn't even try to do that, Mauricio. I just know that I don't have a crystal ball, and I know that even the best and the brightest out there get it wrong. I know that I have a certain investment strategy that I have tried to implement and has served me pretty well so far, which is just trying to find assets that I underwrote in a very conservative manner that provided good cash flow. And when possible, fixed rate debt, right? So I have a lot of deals. The vast majority of my deals are able to weather this storm very well. Now, I do have a couple of deals that have bridge debt with floating rate debt on it that are experiencing some stress. We did buy rate caps, so that's great. But rate caps also expire after a certain period of time. So, but we, I think, are navigating it just pretty well so far. We'll have to see how long this goes on for and to what extent, but I think we're going to be okay.
Yeah, and rate caps not only expire, but also have a cap themselves. I mean, you buy a certain limit above your current rate, so you may have a 2% cap, but if you got it at 4 and you're protected till 6, but if it keeps going up, you still got that delta of 2 between the 4 and the 6 that you got to cope with, right? So you said something that's interesting, because I always hear this, and so I want to push you a little bit and give us some clarity. And I think one of them is the floating rate. Everybody talks, it's almost like everybody talks about conservative underwriting.
Yes.
So what does conservative underwriting mean for you?
That's a really good point, because a lot of people do talk about it. You know, when in the height of the market, or in the past, let's say 4 or 5 years, I saw people who were out there doing a deal a month or a deal every other month. I was doing about 1 or 2 deals per year.
Right.
And that's not because I'm lazy or not because I wasn't out there pounding the pavement, but because I was taking a very pragmatic approach. What I do is I look at historical data and underwrite for those numbers. So we might be buying something at a 3.5 or a 4 cap, but historically that market might be a 6 cap.
Got it.
We were underwriting a 5-year exit 5 years from now at a 6 cap.
Right.
So for anyone who's listening who doesn't know, as cap rates go up, it means values go down. And what a lot of people were doing at that time, they might buy something at a 4 cap and say, oh, well, I'm going to expand the cap rate. This seemed to be a popular thing, like 5 basis points or 10 basis points for every year I'm in the deal.
Right.
And I never understood what the rhyme or reason for that was. I think some guru came up with that plan, and I have nothing against gurus, but I just think that, someone said it and everyone took it as the gospel. And so if you underwrote a deal to expand to a 4.5 cap rate, you're probably in hot water right now, especially if you were supposed to be selling right about now.
Yeah.
And especially if your loan term is ending right about now. Where I was looking at deals and saying, no, historically, this is a 6 cap market. I'm going to underwrite for a 6 or maybe 5.5 if I'm feeling very confident about that market and I wanted to be a little aggressive. But I wasn't doing just this random cap rate expansion. The same thing goes for rent growth. You had places, the rent growth's been 14% for the past 4 years and it's going to continue. And I was like, well, no, it's not, because people aren't getting 14.5% raises in their paycheck.
Right.
You're going to hit a ceiling at a certain point. And the same thing with vacancy, where there was a lot of vacancy and the vacancy has gone up a lot. Delinquency has gone up a lot too. So I took, I think, a pretty pragmatic approach, and so far it seems to have been serving me pretty well.
Yeah, that's gold, because to your point, I mean, I have many clients who, to your point, like, I can't find anything, like nothing pencils out, and so they end up doing 1 or 2 deals a year. And I got other clients that's like, no, we're just doing like 2 deals. They do 6, 7, 8, 10. And it's like somebody's right and somebody's wrong. I don't think both of them can be running at the same time. But then the other thing you said, which is great, which I loved, I asked this a lot too of my multifamily friends and clients, which is, how do you calculate the exit cap? Because that always seems to be a pretty important metric, and I know it's part science, part whatever the word is, but you seem to have a very, very specific way of calculating that, which is just what's the historic cap rate?
Yeah, I mean, I think you're right. It is a little art and a little science, right? And balancing those two. But I take my cues from that historical data. Same thing with the rent growth, same thing with the vacancy. I mean, if current vacancy in a market is, let's say, 3%, but historically, let's say it's 7%, maybe I'm going to underwrite for 5 or 6%. Maybe I'm going to go somewhere in between. And, a lot of it is looking at data, looking at third-party data. You can take a look at CoStar, see what CoStar is forecasting, see what Yardi is forecasting, see how you feel about the market. Take a look at what new construction's coming on, in a particular market. So all of those data points kind of help inform the art of determining what those numbers will be.
How far back do you go on? You said you look at the
I try to
historical.
go as far back as I can.
Okay.
So, I mean, that's usually about 10 to 20 years worth of data. I mean, it's kind of hard because there's a great Mark Twain quote that I love, which says, history doesn't repeat itself, but it often rhymes.
Mm-hmm. Great quote.
So it's not going to be exactly the same as it was before, but there's probably going to be a lot of similarity to it.
Got it. Now, I know you got to run because you're emceeing this great event, but I'll ask you one question. I'm going to flip it a little bit. So I know you're also a passive investor in LP.
Yes.
In a lot of deals. One of the questions I've been trying to help out LPs is, A lot of cash calls are coming down the pipeline. You know, not a lot, but yeah, a lot. Many people are unfortunately need to do a cash call. As a passive investor, what do you look at before committing new capital or fresh capital into a deal? When somebody comes to you and say, hey, Matt, we need another 5, 10, 15 grand from you, what do you look at, or what would you look at before determining whether it's worth putting fresh money into the deal that's not going well?
Yeah, I've been passively investing for quite some time now. I have over 7,000 apartment units that I've invested in passively beyond the 4,500 that I have as a GP. Yeah. And it's something that I've been doing consistently over time. So I have many different deals. Fortunately, a lot of the deals that I was in, the people who were running those deals actually exited like right before or just as things were getting bad.
Right.
So I don't have very many deals right now that have done capital calls, which is really good for me. I'm excited about that. But I have invested in some deals, especially earlier on in my investing, where there were capital calls. And those capital calls were at times when the market was doing really well.
Right.
So I did not contribute to those capital calls. But the reason why was was just the fact that the people who were running the deal were very clearly didn't know what they were doing, didn't have their eye on the ball, and the communication was terrible.
Right, it's key.
Now, if I had a deal right now, one of the deals that I'm invested in, and someone came to me and wanted additional capital to keep the deal going, it's something I would listen to and consider. And what I would want to know is, first off, I'd want to know what has the communication been with that sponsor since I invested in the deal? Mm-hmm. Have they kept up clear and consistent communication? If they have, okay, my ears are open. Tell me, what is the plan? What are you going to do? And I want to see a new forecasting, a new business plan of here's what we're going to do. Here's what we'll be doing with our capital. Here's how much capital we will be contributing. Actually, so I did have a very, very well-known company that does a lot of multifamily value add that I've never invested in their deals because I just didn't like the way they structured it. I don't want to give away too much because it might tip off exactly who they are, but I didn't like their approach. But I was at a conference. They were there. It was right by one of their properties, and part of the conference was a tour of this property, and it was just in a great location, and I loved the property. It looked great, and they only had 1 or 2 spots left because they had already closed on the property and were in the middle of the value add, and I just saw the potential, and I was like, you know what, this looks like a good. So I did. I invested in it, and they got hit with the interest rate, and I think it's going to end up doing fine eventually. But they did a capital call, and I decided not to invest in it. Now the communications with them was pretty good, was fair, I would say, and they did have a really good business plan. And in the business plan, they let us know how much capital of their own that they were contributing to the capital call, which was $0.
Yeah.
Now, if I want to see that sponsor is putting some of their skin back in the game, I'm never investing in a deal where they're not investing some of their own capital to begin with. But if you're doing a capital call, I want to know that the sponsor's taking a little bit of stress on that too.
Yeah.
And they weren't, and therefore I didn't invest in the deal. In the capital call, but I'm still in the deal.
Yeah, and a lot of sponsors, really the more sophisticated, they actually will be the first ones that actually invest their own capital before they even get to the capital call. So they'll try and save they'll do everything possible not to get to the cash call, so they'll put money in first, and then when they still need more, it's almost like the second layer, they'll bring in the investor. So if you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.